Hi, I'm Jamie Hargrove, and I'm the founding partner of Hargrove Firm. We're a national tax and estate planning practice. We're in all 50 states, so wherever you are, we are too. So today I'm here to talk about deferred sales trust planning. And let me ask you this question. If you have a client that is, say they've got a $20 million business that they're going to sell in a few years, what if they could sell it in a way that they defer taxes and don't pay any taxes on that sale for the next 20, 30, maybe 40 years? Do you think your client would be interested in that? Well, that's what a deferred sales trust can do. And there are really two kinds of deferred sales trust. One is what we call an immediate sales trust, and that's where you sell into a trust, and then the asset that you're selling, whether it's a business asset or real estate, you're selling within 2 years. I'm not a fan. I'm not a fan of the immediate sales trust. They do have a purpose and a role in very limited situations, and it usually is in real estate situations where a 1031 like-kind exchange is not a good option. The short-term immediate deferred sales trust may be a play. But I really want to talk more about the 2-year deferred sales trust. And what I want to talk about there is give you the example. So let's say I have this $20 million business. What I'm going to do is I'm going to sell the $20 million business today into a trust. But it's a trust that, depending on the type of trust, it might be what's called a beat-it trust, a beneficiary inheritors defective trust. Or it may be some other kind of traditional trust, but it's a trust that's going to trigger a taxable event. I'm going to sell my business in a taxable event, but I'm going to sell it for an installment note. And many of you have probably participated in installment notes, and what you know about an installment note is you only pay taxes on the principal for the sale of that item when you collect the money on that installment. So what if you had an installment note that said that it doesn't pay you until a balloon payment in 30 years? So you're paying interest every year, but at the end of 30 years, before you ever get a nickel of the principal. Well, that means that you don't report any income taxes on that principal for 30 years. So you might ask, well, that's a pretty good deal. So what happens is I sell to my trust that's a specially designed trust, create this taxable event for this $20 million business. I take back an installment note for $20 million. My business is now in a trust that I actually probably can control that trust. And so now, 2 years and a day later, I now sell that same business, and let's say I sell it for $25 million now to some third party. Well, when that trust bought it from me, it took a new basis. It was a taxable transaction. So the trust has a $20 million tax basis. It sells it for $25 million. That trust picks up gain on $5 million. Now, if this was a zero basis asset, so there was no basis in this, that means there's $20 million that we've not paid any tax on. Now, if that trust immediately pays my client back the $20 million, guess what? They're going to pay tax on the $20 million. But the game plan is I'm going to keep the $20 million in the trust, and for the next 30 years, I'm going to reinvest that. So I'm effectively, if you're in a 4% or 20% tax, of course, for federal, if you're in a state that has a 5% tax, you're looking at another $1 million just on state income taxes in that transaction. So 25% tax on a $20 million transaction, that's $5 million. So effectively what you got in this example is you've got $5 million that you haven't paid on the $20 million, remember. You didn't pay any taxes at closing. You're not going to pay any taxes for 30 years. So you have $5 million of the government's money that if you put that in the marketplace, that $5 million, let's just say that your investment advisor or you're going to be able to put that into an investment fund that's going to generate 7.2% a year on total growth, income, and appreciation a year. Then that means under the rule of 72s, if you don't know the rule of 72s, you take 72, you divide it by your interest or growth rate, 7.2 in this case, and that's the number of years it takes assets to double. So in this case, that $5 million in 20 years is going to double twice. In 30 years, it's going to double 3 times. So my 5 million goes to 10, my 10 goes to 20, my 20 goes to 40. So in 30 years, I have $40 million of the government's money to pay back $5 million. I've made $35 million on the government's money by doing this deferral. Pretty neat kind of deal, right? Now, you say, well, why not do it for 40 years? So here's one of the rules. One of the rules is when I do that sale for that installment note has to be at least 1 day under your life expectancy. So if you're 38 years old selling your business, we can probably do a 40-year installment note. If you're in your 50s, it might be a 30-year. If you're in your 60s, it might be a 20 to 25-year installment note. But regardless, we're going to have a nice deferral. You're going to take the government's money. You're going to make money on their money before you ever have to pay them back. And that's what a deferred sales trust plan does. And we kind of like it.